Volatility as a whole is very suppressed relative to where we've been historically. Investors have really no fear of a correction or something in the market, and that really is the case. Okay, let's talk a little bit about what you need to know before the bell this morning. Markets are doing okay, right? Yesterday, markets were down a little bit. Interest rates were up a bit because of oil prices, not surprising. But again, markets just really kind of doing what they do. And, we continue to kind of be in this correctional period here, August, September. Markets are responding very normally to all that. One of the things, though, that is kind of interesting is looking at the volatility index, which is very, very suppressed right now. Volatility, not surprisingly, has picked up over the last couple of days because of the choppiness in the market. But again, volatility as a whole is very suppressed relative to where we've been historically. And, importantly here, as we take a look at volatility, yes, there's certainly some impact from these 0-day to expiration options. There's been a large chunk or change in the options market to where people are day trading these options that have less than 1 day to maturity. In fact, they make up more than half of all the option trading every day. So there's certainly an impact about that. And there's kind of some theories that this is really kind of suppressing the overall volatility index, and that may very well be the case. I don't have any anecdotal, evidence of that just yet. But what I do suggest here is that, this volatility is very, very suppressed here. And basically going back to this, investors have really no fear of a correction or something in the market. And that really is the case. If you talk to most investors, they're like, yeah, market's great, it's doing fine, it's only going to go up from here, we're good. Markets are back. No worry about a potential recession or anything else that might occur that would impact stock prices. The volatility index is kind of confirming exactly that sentiment. Now, here's the interesting thing about this. So when we start talking about volatility at these very low levels, volatility over the past, decade has had periods of these very low readings before, and they all do eventually end, and they eventually end with a bigger market correction at some point. What triggers that, I have no idea. But right now, if you take a look at where we are in terms of the yields on markets, right? So the dividend yield across the entire index is at a very low level relative to where it should be in this type of a market. And with volatility at these levels, it suggests that yields are going to be higher in the future. And this particularly dovetails with the fact you have very low volatility, very high valuations, very low yields. You start putting all those together, what that suggests is that yields are going to rise on stocks at some point over the next year. And that's historically the way that this has worked out. So how does that happen? Well, in order to correct valuations and get yields up, stock prices have to go down. So the question is when does that happen? What causes that to occur? I have no idea, but volatility continues to be one of those measures we want to watch because that's kind of an early warning signal. If volatility starts to rise, that is going to give us good signal of potentially the risk coming in the markets. That's what you need to know before the bell this morning.